Hey everyone, how's it going? I still haven't set up my camera, so this will be all screen share for today. And I'm sure the topic that is on everyone's mind, or at least is one of the things on everyone's mind as related to the markets, is what the heck happened on Friday, right? So let's take a quick look at that. We had this market come down. And this was a pretty big move. I'm looking at the wrong thing, so it's wrong. And the first time that we came and we touched the MA50 in over a year. So this was a pretty significant move downwards. If we take the proper perspective, however, all we did was come down and touch that MA50 and come to the bottom of our box. So if you look at headlines, let's see. Uh, well, the headlines may have changed because a few things did happen over the weekend. Okay, so now we're on to what's happening in the Middle East. Okay, so if you saw the headlines on Friday, they were all doom and gloom. Like Dow has the worst day, uh, all year, or the worst day in like over a year, and we have this big drop and the sky is falling, all these headlines about how terrible the market is. And if all we did was go by the news, we'd get really scared. So whenever we see that happen, we want to evaluate very carefully because there are going to be a lot of people who are just get scared. They don't even look at charts. They don't even look at anything. They just receive the news from whatever news source that they like. And if you were in that position and you heard the headlines and you heard that it was the biggest down day in the Dow in over a year and it's the worst trading day, blah, 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 whatever, then you may get so scared that you're driven to action where you go to your 401k and you start saying, hey, put me into cash or put me into, oh, get me out of stocks, rebalance my portfolio. Or you go to your financial advisor or manager and say, I'm so scared, get me out of this. But when we take perspective, it's not that bad. We're right at support. That support could break, that's possible, but it's not time to be afraid or to panic yet. Maybe it's time to hedge, but it's not time to panic and say, oh, doom and gloom, everything in the sky is falling, everything's moving downwards. It might happen to be the case where everything does move downwards. However, I don't think that's going to happen. That is the lower probability event. I put it at about 35, maybe 40% that we break down from here. Okay. Why do I say that? Number one, the market has been really strong and we've shrugged everything off so far. Number two, news headlines are the perfect situation for market makers and certain institutions to make a whole bunch of money. Or, oh, a whole bunch of fear? Easy. I'm going to sell a bunch of stuff and watch this market go up. and then, or sorry, buy a bunch of stuff. They're going to sell. I'm going to buy a bunch of stuff and then watch the market go up and make my money. So the only challenge to that is the news. Okay, so this came down not because of the CPI, like some news outlets are saying. That CPI was this right here, okay, not on Friday. Friday mostly happened because it appeared that Iran was moving military assets around and potentially striking Israel. That was Friday. And then I don't remember the exact timing, but sometime, I believe it was Saturday. It might have been later on Friday, but on Saturday, by Saturday, Iran was actually sending drones in to attack Israel. So there might be another negative market reaction to that. But in the face of a strong economy, the face of strong reports, like JP Morgan, okay, surprise to the upside, okay, and the both earnings and revenue and their projected future was strong. It was actually good. It was an extremely good report. We just got an extremely negative reaction to it. So a lot of times the reactions to earnings are unpredictable or something else overshadows. And so this is probably a huge overreaction in JP Morgan. It was actually really good news. So the economy is strong. The only thing that has happened is a geopolitical war event. So what happens in those types of events? Well, we've already gone over this because right at the very beginning of the year, we said there is heightened potential for war in 2024 and military action that includes the United States in 2024. So far, officially, the United States is not participating, although the United States did shoot down some of the drones. But officially, according to Biden, we are not part of this conflict yet. And we're not planning or hoping to be part of the conflict. However, at the beginning of 2024, right, it was like January 15th or 20th, something like that, we noticed that they changed the rules of the draft in the US military to no longer require a GED, no longer require a high school education or equivalent. So making it a lot easier for us to recruit and increase our numbers of troops, which we noted and we thought was really interesting. And say, why do we do that? Only if there's expectation of needing more troops. And so we said we were going to start paying very close attention to the defense sectors. And at the same time, we saw an increased interest in ITA. Really, that's when ITA turned around. It didn't, from this movement downwards right here, this correction right here, and it's been up ever since. You came and hit this MA50 on Friday, but this is still very much a trend that's intact. Okay, I could draw it maybe like this and say, oh, maybe we just broke down from it. But realistically, with that support right there, I don't think so. And with everything that's happening right now, I don't think so. I think we're going to get a nice sharp bounce come, well, maybe as soon as Monday morning because of the action that happened in the Middle East. So all of this is to say that markets don't really care. They only care for a couple of days at most. And I don't remember when it was, maybe last week or the week before, where we actually looked up when Ukraine-Russia war start date. and it was something like February 20th, 2022. Okay, February 24th, 2022. Okay, so what happened on February 24th, 2022? February 24th. Huge gap down on the open, traded right back up, even higher than the previous day close. It didn't even last one day. It gapped down, and we trade all the way back up. And over the next couple of weeks, we traded back down, not as low as where we gapped down, and we made a huge recovery right here. And by here, this is different. This is not the war. This was just the market continuing to move in the direction that it was going to move. Okay. So the war, the start of the Ukraine war, had only a few hours of effect. So will this start of the entry of another country into an existing conflict? How big of an effect is that going to be? And my answer is most likely limited. It shouldn't be as big of an effect as the beginning of Russia invading Ukraine. This is just Iran lending a hand to one of the sides of the conflict. So I'm not expecting a huge downward move. Or if we get the huge downward move, I'm expecting a recovery. The only caveat is that it happened at a support, so it could be a break of support, and there is pent up fear along this way of a correction. So we've been anticipating at least a 5% correction. So this down to the MA50 is only 3% correction. And we have a tendency to, on average, have maybe one or two 5% corrections or pullbacks during a year, and maybe one 10% correction during the year. So this could potentially signal the start of a 5%. 5% from the current level kind of puts us in no man's land, but by the time it happens, it may be this MA90 right here, but it also is associated with this level right here, which has a little bit of support. Okay, we have a little bit of activity right there. If we go 10%, then we're looking at that MA150, and it happens to be this level of consolidation right here. And by the time we get it, we may be also pretty close to that MA200 as well. So overall, I wouldn't expect this to go bearish. It wouldn't flip us to a bear market. It would just be a pullback or correction in the current bull market. And from where we're standing right now, there's no guarantees that we're going to continue to move downwards. It just looks like we're sitting there right at support. And if this market reaction was because we were afraid that Iran was going to strike, that means this is preparation for Iran to strike, which means a lot of the institutions, they're already in position. They don't need to react to the event of Iran striking because they already prepared for the event. The people who react are the ones who weren't prepared for the event, so that's mostly going to be retail traders. And so we might get a huge reaction at the open because retail traders did not anticipate and did not prepare themselves for it. And then, if appropriate, institutions may take profit at that point in time. If we gap down like we did on the Ukraine war over here on February 24th, what is that? Why did we gap down? Because it seems like all the institutions were ready for it. They were preparing for it on Wednesday. The retail traders got shocked by the news, and so they were panic selling. And what happened? Institutions took profits. Oh, huge overnight gains. Let's take profits. Bam. They go right back up. So that is probably the most likely scenario that for us to happen again today, although it doesn't necessarily have to, or not today, tomorrow, but it doesn't have to happen over a single day. It could happen over a few days. Now, if more news comes out, for example, Iranian drones hit an American warship. Uh-oh. Now we're afraid that the US is going to enter the conflict, and that can continue to drive things down. So just from what has already happened, we're not going to expect this to have a lasting effect and send us downwards. But the situation is still developing, and more events can happen, and that could drive us downwards. And so there is definitely risk in this market, and therefore we would want to hedge that risk. So now is an appropriate time. So it's not too late. We didn't hedge on Friday, which was probably, in hindsight, that was my mistake, because I was ready to hedge for the few days before it and the weekend before. Why wasn't I ready to hedge yesterday or on Friday? So I missed that one. But is it too late to hedge now? The answer is no, because the Iranians entering the conflict could just be the beginning of an escalation. So it's still appropriate to hedge. And this could still go down to that MA90 or that MA150. Okay. But it's not anything to panic about. It's just knowing and understanding the situation. It's something to say, hey, maybe I need to reposition myself and understand that we are at the lower edge of this box, and there are non-market events that may affect the market in a way that causes me to break down outside of this box. And so I want to be prepared and hedge for that. Okay. So if I look at everything else, bonds bounced up, came back down a little bit, but still higher than the previous day. Look at my dollar, it's spiking way up. Okay, if I look at ITA, it went down with the rest of the market, but held right here at the MA50. And so what we're going to expect, other than maybe opening down on the market, on the SPY, is increased interest in energies. Okay, so we did get that sell-off on Friday, but that could be a very good entry point for institutions. And then energies and defense, ITA, we looked at them both. Okay, so we may start to get very active in the defense sector. If I look at which stocks, do I have I don't know if I should have, since we started to pay attention to, I'm not signed in. It's weird. I should have an ITA watch list. Yes, there we go. Okay. So if we go to our sector scan, and we focus it in on those defense sector stocks, then what would be a really pretty smart move is to do a pair on the defense sector. Find one that's doing very well and very strong, and find one that is lagging and pair those up. Okay, so this could be a good candidate. SPCE, Virgin Galactic. I would probably want something that was more directly defense. So I would do this one. I would have to find out what they do. ACHR. Okay, so urban mobility. So I would want to know if they do any military stuff or if they're all civilians. But based on what they do, it looks like they might do military stuff. Virgin Galactic should really not be part of military. So RKLB. I don't want to spend too much time on this, but we can just look very quickly. Yeah, civil, defense, and commercial markets. So Rocket Labs could be our weak candidate for the pair. And then for a strong candidate, Textronic is looking pretty good. RTX is looking really good. General Dynamics is looking good. TransDigm. Oh, that's so weird. Is there no Northrop Grumman? Raytheon? Which one? What's Raytheon? Is Raytheon gone? Oh, they got absorbed by Northrop Grumman. So it's interesting that Northrop Grumman is not on this list. Let's see. And same with Lockheed Martin. I didn't see Lockheed Martin either. That's really weird. Oh, there it is. It is there. Let's add Northrop Grumman. And really, Boeing should be on here too. Yep, Boeing's there. Okay. So let's take a quick look at. I clicked out of it. Okay. Well, in any case, we can build a pair for the defense sector, because as this, or if this conflict escalates, then there's going to be increased interest in ITA. It's done well so far this year. When we first identified that it might be a good idea to start paying attention to it, and now it's really looking like it might be a really, really good idea to start paying attention to it. So we may go in and look at some opportunities over the next coming weeks and months in ITA, either as the ETF or components that are in the sector. Okay? So really what we're looking at is geopolitical risk is the largest risk in the market today. And on top of that is earnings. We have earnings starting to come out. We saw earnings from JPM. We have Bank of America, other large banks coming out this upcoming week. And as long as they're doing okay and they're doing well, then that is still strength inside of the markets, and that we can expect that any pullback that we get from the news in terms of conflict as to be more likely to be shorter term. But in any case, I would be a little bit interested in playing a bounce off of the bottom of this box, or that MA50, as long as we don't break through it on Monday. And failing that, then that MA90 or that 5% mark, and then that would be another great chance to get in on something, just call it longer term. So a couple weeks to a month, or maybe even a few months. For sure, if we break that, then the third opportunity is at that MA50, MA200 level. this horizontal level right here. So we're talking about this horizontal, maybe I'll just draw them. This horizontal region, it's not exact. And I believe it was this one right here, okay? So as we get near those, we'd be looking to do some high reward to risk ratio trades or hedges, right? You can consider, so hedges would be if it comes down, and the reverse hedge or a high reward risk ratio for a bounce. And it could even be done, you could even do both. As long as it's a large move, then you would make up for the cost of both of them, right? So if we hit these levels and we just chop sideways, then we lose on both sides. But if it bounces hard, then any money that we lost on the hedge would be more than made up for on the gain of the high reward risk ratio trade. And the opposite is true. Any loss that if we crash hard, then anything that we lost from the high reward risk ratio trade would be more than made up for in the hedge. So that's a way of playing both directions if we're really uncertain. But in any case, the hedge should be in place before we hit this level. And so then it's really just a matter of deciding whether we want to do a high reward risk ratio trade. Give me a moment. There's a lot of background noise. It's very distracting for me. So let me take care of that, and I'll be back. Okay, sorry about that. All right, so tech was starting to get a lot of attention before this conflict thing. So, and tech obviously gets very hit first and hit hardest when something like conflict happens, because they're the higher risk assets, and people will take their money out of the higher risk assets first, and they may even reallocate to a lower risk asset before taking the money out completely. But XO or QQQ really it didn't move that much. It moved 1.59%, which is somewhat large. I mean, it's not outside of normal, but it is somewhat on the larger side. But you can see that bar is way smaller than all these other bars. It's just that there's that gap down associated with it. That's why it became a somewhat larger looking bar, or a larger move, 1.59%. We were sitting again right at that MA50. And the MA50 has held so far. We'll see. We'll see what happens on Monday. But realistically, putting everything in that has already happened, I would just expect the market to continue moving as if there were no news. There is the chance that there's an escalation, however, and that's the risk. That's really the only risk in the market right now. If we didn't have the threat of maybe the US or European nations joining in the conflict, or other China, Russia, other Middle Eastern trying to take sides on what's happening over in the Middle East, then I would say, okay, we're going to chop sideways. We have a high probability, 70-80% chance that this MA50 is going to hold. And same with the SPY, we're right at that MA50, and the Dow Jones, we already broke down, broke down below that MA90. So I would say, okay, we've got some risk. We do have some horizontal support right here. Okay, so maybe a little bit more and maybe a bounce off of that. That's what I would be saying. However, right now, there is the chance of escalation, of more and more nations entering in. So we've avoided that in Ukraine, Russia. It's mostly really just been a proxy war with two sides, with just Ukraine and Russia, and everyone else has been playing a proxy role, meaning that they haven't actively participated in the conflict, but they've sent weapons, they've sent money, right? They haven't sent soldiers. The same thing was up until this point was true for the Israeli Palestinian, and I guess technically the Iranians haven't sent people. At least we haven't heard any news of them sending people yet. But it's a little bit different. Say like, hey, let me give you these weapons, and then you go and launch them at your enemy, versus let me use my weapons and launch them at your enemy. That's a little bit of a different action. So there is some escalation happening in the Middle East, and so far up until this point, everything has been proxy. Also, oh, let's send you support, let's send you some money, let's state that we're on your side, let's send you potential promises and whatnot of how we're going to support you. But at the same time, we've been saying these are conditions and don't cross this line and don't do this. Okay. So with Iran joining in, now that's a slightly different story. And then with the potential of other nations joining in, that's the only reason why, instead of saying we've got a 70-80% chance of bouncing up right here, now I'm at about 50-50. Okay, because I just don't know how those events are going to play out and when they're going to play out. So what could happen is everything stays as is and we bounce off, and then after a week another nation joins in or something like that, then we come crashing down again. And really, I shouldn't say crashing down, because that would be more of a choppy sideways movement. But at some point, something is going to crack and give us that 5% pullback or 10% correction. It doesn't have to be conflict. It's just going to be whatever it is just going to be some excuse, and the media will use that to say, oh, this is why we're crashing. And the answer is no, we're not crashing. And no, whatever you're telling us is not the reason why it's happening. It's the reason why it's happening is that we've been moving up since October. So like 6 months straight up in this incredible bull run that is probably the strongest bull run that we've seen maybe ever, if not. I mean, look at that, the slopes of these, right? This has been so strong. It might be the fastest, or maybe the V bounce on COVID was faster. Where's 2020? No, the V bounce was not faster. Okay, so this is really fast. Really fast, and it has to come down, it has to correct. And when it does come down and when it does correct, something will have happened in the world, and the news agencies will blame that something for the correction that happens. And it's not true. It's just the natural rhythm of the markets, right? We came up, we pull back. Trend line. I need a line. Okay, we pull back. Then we go up, then we pull back. Okay. We go up, we pull back. We go up, we pull back. Okay, it's just the natural rhythm of the market that this has to pull back. It's not going to keep going straight up forever. It has to pull back at some point in time. And guaranteed something will be happening in the world at that time, and it'll get blamed for the pullback. But when really it's just a natural phenomenon. It's like saying we got high tide and we got low tide, and every time we get to high tide, something happens. Like, oh, I don't know, President Biden had an apple for breakfast. Okay. Oh, that's why we're having the low tide. No, the low tide would have happened whether or not Biden had an apple for breakfast. Okay. It just, we like to associate, or our news media likes to associate events with what are natural market rhythms. Okay? And we might accelerate, might have 1 day influence of that news, but like we saw in the Ukraine conflict, it's very short-lived, very short-lived. Okay? So what we need to ask ourselves is, where are we in this natural rhythm of the market? And is there an unnatural force that is being applied to the market? And the answer at the moment is no. And so our expectation should be continue chopped sideways, because that's what we were looking at before any of this news came out. Okay. So we're just going to treat the news as the news. It may have very short-term effect on the market, but overall, unless that news becomes extended and constantly escalates, then that becomes an unnatural force on the market. A singular event is not an unnatural force on the market, except for maybe a few hours. So right now we're expecting continuing chop sideways. If we are going to break this MA50, we have this support right here, and that would be a 5% correction. That would be very natural in the markets, or not a 5% correction, 5% pullback. Okay, it could develop into a 10% correction, still very normal for a market that has run up so quickly in the past 6 months. So don't panic, don't get afraid, don't look at the headlines, because they will tell you all sorts of lies, or wrong conclusions, I should say. Maybe not outright lies, but they're just random attributions rather than actual cause and effects. So everything is looking okay in the market. So obviously we're not in this uptrend anymore, but we're not trending down. There is a little bit of risk right here because of the geopolitics, but other than that, there's nothing to get excited about. Okay, so what will happen almost for sure is that VIX will start to spike. Okay, so you see we came up, we ended at 17.3, we came as high as 19.31. That's the highest we've seen since this past November. And we could live in this region, or maybe a little bit higher, for a while, as there is definitely heightened uncertainty because of the geopolitical risk. But in terms of directionality, so far we aren't going to expect an effect on that. Okay, so a volatility hedge might be a smart way to play it. Okay. All right, I think that's pretty good and thorough. There's really no need to look at all the sectors and all of that, because the focus is going to be on conflict at the moment. And so really our attention should be drawn towards the energy sectors and the defense sectors. And behind that is inflation, right? We can't ignore that inflation still exists. Actually, this could be a really good distraction for Biden, right? If inflation is a very sticky and bad topic for the incumbent president. So any news item that shifts the voters' attention away from perceived failings of the current administration is kind of doing the current administration a favor. So they may welcome the news distraction, instead of seeing all these headlines on CPI and how it's getting worse and inflation is not under control like we thought it was, and look at all this agriculture, how prices are increasing like crazy, and if energy spikes, then your energies. And of course we look at core CPI that removes all of this stuff, but can you really ignore all of this stuff, right? So if I look at the commodity index, it's kind of doing the same thing as the agricultural index. So we do want to keep our eye on that. Inflation is still important to pay attention to, because even if the public forgets about it and maybe retail traders forget about it, normally most, at least well-established institutions, they will definitely will not be ignoring it. It'll definitely still be on their minds. So we'll want to pay attention to agricultural prices, commodity prices, fuel prices, because those are all on this still very much on their upward path. Whereas the S&P 500 and the QQQ have flattened out, these have not at all. These are still extremely, in fact, increasing in slope, right? So almost starting to look a little bit parabolic, right? Which is not great news for inflation. All right. Okay. So hopefully I've alleviated your fears, given you good perspective on what the markets are doing. Are there any questions? Anything that anyone wants me to go over or look at? I can't see you guys. uh, and let me make sure no one's chatting. Okay, so I don't see anyone typing in or here. Well, my speakers are off again. So I'm gonna assume that everyone's good. No questions?
Connected.
Okay. All right. So we'll end it here. So overall, market still moving sideways. We have about 50% chance of breaking that MA50 only because of the increased geopolitical risk. Otherwise, we would expect to bounce with a 70-80% chance of bouncing off of that MA50. And we just want to overall just have a bit of a geopolitical risk hedge on our portfolios. But everything is fine. Right? I wouldn't worry about this at all. And it's definitely not the same or as big news as the start of that Ukrainian war. And it's happening at a point where we're at a strong market and strong economy. So the effects of it should be quite limited unless it becomes very extended and draws more nations in. Okay. All right, guys. Next Sunday, I will be traveling. I'm traveling away on Tuesday and back on Sunday, so I won't be able to do the weekly market review next Sunday, and I won't be able to do the pre and post market sessions on Tuesday. I may or may not be able to do the pre-market session on Wednesday. I'm not too sure about it yet. I would say that it's highly likely that I can, but there is a small chance that I cannot. So I'll update you guys as Wednesday gets closer. But for now, just know that I might not be able to make it. And then next week, we won't have a session. Next Saturday, we won't have a session because I will be traveling. Okay. All right. Thanks, guys. Have a wonderful rest of your day. And I will see you guys hopefully, maybe in the pre-market session tomorrow.
Thanks, Jay.